Have you ever looked at a stock and seen two experts, two really smart firms, look at the exact same data and come to totally different conclusions? It's confusing, right? Well, that's the puzzle we're digging into today. We are going to deconstruct two professional analyses of a tech company called Lumine Group and really get to the heart of what I call the analyst's dilemma, that fascinating place where cold, hard data meets human judgment.
So how do we get to the bottom of this? Well, our story really kicks off with two deep dive reports. Both of them are looking at the same company at the exact same point in time.
And the two firms we're looking at are heavy hitters. On one side, you've got Morningstar, famous for its super in-depth, long-term focus research. And on the other, you have CFRA, another highly respected independent research firm that leans heavily on its quantitative models. They're both looking at the same set of numbers, but as you're about to see, the way they interpret them will send them down two very different roads.
All right, here's our game plan. We're going to start on common ground, the one thing they both agree on, the company's absolutely impressive growth. Then we'll dive headfirst into the conflicting signals around its valuation. After that, we'll explore its competitive defenses, what they call its moat, and finally, we'll see how all these pieces lead to two totally different final calls.
So, who is this company at the center of our whole story? Lumine Group. They're a tech company with a really specific strategy. They're serial acquirers. They go out and buy up software businesses in the communications and media space with the whole goal of strengthening them and growing them for the long haul.
Let's start with the most exciting part of Lumine's story. This is the one thing that both of our expert sources point to and say, wow, look at that. We're talking about explosive growth. Okay, just look at this number for a second, 44.1%. What is that? That's Lumine Group's 3-year compound annual revenue growth rate, or CAGR if you like the jargon. All it really means is the average rate that their revenue grew year over year for the last 3 years. And let me tell you, in today's market, a number like that, it really makes you sit up and pay attention. But let's give it some context.
So how good is that 44.1% really? Well, according to CFRA's data, it's not just good, it's phenomenal. Over the past 3 years, Lumine's growth has been more than double the industry average of 20%. That is incredibly strong. Now, you might notice their 5-year number is a little below the average, but it's that recent acceleration that has everyone's attention.
And hey, this isn't just one firm's opinion. Morningstar is right there with them. They call the company's growth robust and say it points to a favorable future trajectory. So, on the topic of growth, our analysts are in total agreement. It's a fantastic positive story. But this is where the easy part of our story ends.
And that brings us to the much trickier, much messier picture of valuation. See, when analysts look at a stock price, they're asking a really critical question. Is this fast-growing company a fantastic bargain, or is it a trap waiting to spring?
Now, at first glance, Morningstar's data makes this look like a slam dunk. Their fair value estimate, what they think the stock is actually worth, is almost 33 Canadian dollars. But look at where it's trading, closer to 24. That's a 27% discount. I mean, that is exactly the kind of thing value investors get excited about. Based on this alone, you think it's an obvious buy. And CFRA's models are pointing in the very same direction. They actually list valuation as one of the main positive drivers behind their recommendation. So both firms see an attractive valuation. Simple, right? Case closed? Well, not so fast.
And here it is. This slide is the absolute heart of the dilemma. On one hand, you have the bull case. A big discount to fair value, a lower PE ratio than its peers. It looks cheap. But then you look at the bear case. Morningstar slaps a high uncertainty rating on it and warns of a potential value trap. That's when a stock looks cheap but has hidden problems. They also point to a high enterprise value to revenue ratio, which can be a sign that the market might be a little too optimistic. It's the classic puzzle, a stock that looks both cheap and risky, all at the same time.
So, all this uncertainty naturally leads to the next big question. How safe is this business over the long run? How well can it defend itself? And for that, analysts have a great term, the economic moat. Now, for anyone who hasn't heard this term, it's a great visual. An economic moat is just a way to describe how well a company can protect itself from competitors. Think of a castle. The moat is what protects it from being attacked. In business, it's the competitive advantages that protect its profits. And this is where the story gets really interesting. Morningstar's data shows that this company's defenses are actually getting stronger over time. You can see right here its economic moat rating has improved, going from no moat all the way up to narrow moat.
This is a huge clue that their buy and build strategy is working. As they buy more companies, they're building a stronger, more defensible business. So what does a narrow moat actually mean in Morningstar's world? Well, it means they think the company has solid competitive advantages that should let it earn above-average profits for at least the next 10 years. It also tells you they view its financial health as pretty solid. This is a big vote of confidence in how durable the business is.
Okay, so let's recap. We've got mind-blowing growth, a really confusing valuation picture, and a competitive moat that's clearly getting stronger. So how do our two expert firms take all these pieces and come up with a final recommendation?
And here is where those two roads completely diverge. CFRA comes out with a clear, unambiguous buy recommendation. Their model puts the most weight on that incredible growth and the favorable valuation. Morningstar, though, pumps the brakes. They issue a 3-star hold rating, but even more importantly, they say the rating is papped. That means even if the numbers looked better, that high uncertainty and the risk of a value trap are so significant to them that they can't go any higher.
And that, right there, is the analyst's dilemma in a nutshell. Both firms saw the same amazing growth story. Both of them saw the metrics that made the stock look cheap, but they weighed those facts differently. CFRA's model focused on the upside, leading to a buy. Morningstar's analysis put more emphasis on the potential risks, leading them to stay on the sidelines.
And this brings us right to the final question, the one that every single investor has to answer for themselves. Because at the end of the day, analysis isn't just about finding the facts, it's about deciding how much each fact is worth. It leaves us with the ultimate dilemma, one you can now apply to your own thinking. How do you balance the incredible pull of strong growth against the serious caution demanded by high uncertainty?